Hi everybody, Alex Pro here from Expert Forex, and in this video I'm going to explain exactly how topping up a successful trade can triple your trade in effectively one transaction. And what's more, I'm going to supply you with a downloadable model that you can use to create strategies that achieve the very same results. Now, a while ago I made this video where we created a record. There were 11 tripling of account trades in 48 hours. Please go and watch this video. A link will be in the description of this video, or in the first commentary of this video, and it gives you all 11 trades and the strategies used to achieve those tripled accounts. Now, this whole philosophy comes from our double in a day Forex robot, which you can use to either double your account or triple your account, or actually just achieve the gains that you want to achieve using a top-up process. What we also then did is we automated the entry into these trades using an RSI envelope trader. So the RSI envelope trader finds the entries, and the double in a day top-up process makes sure that you get the best out of those entries. And so here is the top-up calculator, and it looks very complex. I'm going to try and keep it as simple as possible. So how do you triple an account? Firstly, you start with let's say $1,000 account. In this case, we're starting with a $1,000 account, and you enter a deal. In this case, 150 pips is the target for this particular deal. So you enter it there and it goes successful. And as it's going successful, you add more trades to the deal. You either top them up or you add trades. And when the deal hits the target, you will have created $2,000 of income. On a $1,000 account, that means you've tripled the balance of your account. So that's very simply how it works, and here it shows the process when successful. It's not going to be successful all the time, so let's have a look at the alternatives that these transactions can take. Firstly, you can enter and it can hit your stop loss. So these transactions do have a stop loss, and normally they about 5% of the capital that you're using. So in some of the cases, the transactions will hit your stop loss. In other cases, they'll go successful. You'll top up once, but the price will retrace, and we have worked out the stop levels to be almost break even, slightly positive, but almost break even. So in this case, it goes up, comes down, and you make a 45 cents profit. The next thing that can happen is go up, activate your first top up, go up, activate your second top up, and then retrace. And if it retraces to the break even stop, you'll make a $1 type of profit. Then the other thing that can happen, it can activate the first top up, activate the second top up, activate the third top up, and then retrace. And if it hits that stop, you'll make a $1 profit. But obviously what we want is it to just continue straight on and hit that particular target. Now, how this works is as you can see, it's almost like a grid system. Here is the start. The top-up happens at a level that you can decide on. It could be 25%, 30%, 35%, 40%, and so on. The second top-up is normally around about 50%, and then the last one is again a factor of the first top-up in reverse. So that 35 would be 65. And then from then on, the race is on to get to the 100% level where you will make $2,000 profit. So that's how that works. And the other thing about this model, it works out the lot sizing. So the only lot sizing you have to enter is the entry lot sizing. And this yellow line over here is what you have to enter into the model and also into the EAs to create the strategies that will do these fantastic things. So in this case, we would have entered 0.27, and there it is, 0.27. Then it calculates, for the second top up you need 0.39 lots, For the third top-up, you need 0.70 lots, and for the last top-up, you need 1.46 lots, because that will double your account, and that takes spreads into account. So the model will calculate all that for you. You just need to tell the model what your account size is, what the pip value is of the instrument that you trading. Normally the pound USD or the euro USD and those kind of currencies have a $10 pip value for a main lot, what kind of leverage you're using, and for this system it is almost imperative that you use extremely high leverage, the highest leverage that you can possibly get. 100 to 1 may not work for your particular broker. So high leverage is one of the key elements of success for this to work. Then you tell it what spread. If it's a 1 pip spread, that's what it is. Then you, because of the leverage, the system will work out the margin that you require for each main lot, or you can enter the margin if you do know what it is. Then you tell it when you want to start your top-ups. In this case, we're using 35% is the top-up. How big your target is. In this case, it's 150 pips. And then you tell it what your initial stop loss is. Now, one thing about this system is it will make sure that whatever you start your stop loss to be, it'll use the same stop loss for every single top-up. And that's quite important. You want to give every single transaction the same chance of success. If this stop loss is, for instance, only 10 pips, it will get stopped out very quickly. So you want to spread your stop loss sizes over all 4 of the transactions that we have. And you can see here 21 is the stop loss, 21 is the stop loss, and 21 is the stop loss there. Tell it what and then, as I've said, the initial lots. It will then go away and calculate what the lots should be for the next few transactions, and it will also calculate these break-even stops that will be necessary, where you can just make a very, very small profit if the prices retrace. So that is essentially how the calculator works, and I'm going to show you a few examples of how strategies are created using the top-up calculator. So just to repeat, critical success factors are the leverage you're going to use, the account size. You don't have to use $1,000. You can use $2,000, $3,000. The smaller the account size, the more difficult it is to get a valid strategy. You want to balance your risk, and that happens automatically through the balance stops. You want the level of your initial lots will determine the nature of your strategy and the validity of your strategy. The size of the trend, again, the bigger the trend, the more return you're going to get on your money. The smaller the trend, the smaller the return. You need to go for a good risk return ratio. I'll show that in the model. And then using an automated model like I've just shown you here is really key to just create the strategies that you want, save them in your robots so that you can pull the strategies up at the click of a button. So you don't find a deal and then suddenly work out a strategy. You do it before the time, and you have about 4 or 5 strategies saved in your robot, and you just call on them whenever you need them. But it'll all make a little bit more sense when you start looking at the top-up calculator. Just a quick risk warning. Trading the markets is risky, and the market can change at any time. Nothing is guaranteed. Past results are not a guarantee of future results. Okay, and here I am in a Excel workbook. We have a number of top-up calculator sheets. I'll go through them one by one. Here's the basic calculator, and it shows the whole strategies as you design them, and I'll show you. I'll experiment with a few things and show you how all this information changes as a result of the experimentation. But In this workbook, I have a strategy for a 200% return, which is shown over here. So your return is 200%, your risk is just over 5%. Then we have one with 100% return, also with a just over 5% return. But here the trend is that is needed is much smaller. So the trend plays a role. Then we've got one with an 80 pip trend where you're only making roughly 70% return for a slightly higher risk. And then there's one year with a 50% return with a 5% risk, but then you're using an 80% return, an 80 pip trend. So there are some and here's one with a 40% return, risking 4%, risk return ratios 11 times, and you're using a small trend of only 60 pips. So there are some standard strategies that are included in this workbook. And then there are some other ones where you can start creating your own strategies. And how you create your own strategies, and I'm going to go to the front page here, is you play around with these yellow areas. You cannot enter, you cannot change anything on here. If you click on here, if you try to enter any number there, it will say this is a protected sheet. You cannot make changes to any of the calculations on this sheet, even those areas you can't make any changes. The only changes you can make, you can only enter values in the yellow blocks below. So there are the changes that you can make. So for instance, if you want to use a bigger account size, you go like that, enter 2000 in, enter it. And as you can see, changing the account size hasn't really changed the results at all, because the results are driven from the other things that you enter. But let's go. So as you've seen, changing the account size or making it bigger hasn't really adjusted the results, but there's a very important element that makes your strategies valid, is whether you have enough money in your account to fund the margins required. Now we have calculated the margin there at 200, so it actually looks at your lot sizing. It says on that lot sizing you're going to need margin of that, on that lot sizing you're going to need a margin of that. So it calculates the lot sizing. And you will see on some of the strategies, the margin gets too big and the strategy becomes invalid. So that's where you need a bigger account size. So let's just push that back to what it was. Pip size, I'm going to leave as it is. Leverage. Okay, let's have a look at leverage. So let's change the leverage to 100 to 1. So immediately it says this is now an invalid strategy. Now why is it saying that? Because you don't have enough money in your account. It says you need $2,800 just for margin. So in other words, this strategy is only tradable if you have, let's try 400 to 1. If you have a 400 to 1, and let's try 300 to 1. Yeah, that's a valid strategy. So this strategy will not work if you don't have at least 100 to 1 leverage. There it says, oh, yeah, it will just work on 200 to 1, but it will not work on 100 to 1. So that shows you the sensitivities of these strategies. When you cannot make a strategy work, then you have to play around with some of these settings here. But leverage is a major one that plays a role. So I'm going to put that back to 500, and suddenly we have a valid strategy because we've got enough money in our account to pay for the margin. All right, spreads, normally that's a 1 pip spread on the euro or the pound, and then the margin depends on your leverage. The higher your leverage, the lower the margin requirements. Okay, then we have the trading element. So you can now tell it whether you want to start at 35%. Let's change that to 30 and see if it changes the result. It actually improves the result. So this is where you can play around. You can experiment with these settings. You can change that to, let's say, 25. It hasn't improved it. Then we go to 30. It's improved it. Now let's go to 35. Oh, so now we know that 30 is the sweet spot for topping up. That it's increased it, and it automatically increases or changes all of the settings down here. There you can see the new target is in place, and so on. Then then let's move on to the trend that you're going to be looking for. Is it 150 pips? Let's change it to 200 pips, and we change it over there. You see it changes over there. Oh, all of a sudden, now instead of making $2,000, we are making $5,000. So it just shows you if you're able to move the trend from 150 to 200, it has a massive impact on your strategy. And although you need more money in the margin for margin, the top-up gains, by the time it reaches that top-up level, is already so high that you only need $300 in your account for this particular strategy. So there you are. Now we've got a strategy that will take a $1,000 account to $5,000. Amazing strategy, isn't it? So now we found out that the target, the take profit target in pips, is the sensitive one. We'll move it back to what it was, and there's what it was. So let's go the other way now. Let's go to 120 pips. So we go there. Oh, see, that's now halved. It's almost halved. By reducing it by 30 pips, your income has halved. So it's all very related to the input, and this is why you need to play around with this model to get some really fantastic results. So let's go back to 150. What else is there? All right, so then it asks you the initial lots. Now, to be honest, there are no rules for this one. It is trial and error. So let's say I started out with experimenting with 0.1 lots. So we go 0.1 lots. What happens? Okay, our income drops tremendously. It's a safe strategy. It returns 78%. On on 2% risk. So again, it shows you how you can play around with your risk exposure and your return exposure by playing around with lots. What was it? I think it was 0.37. I think, or 27. Was it 27? 27. Now look at that 37. How it pushed the income up. So these are the sensitivities. The lots, the trend that you're going to be going for, and even the top-up percentage is one. And also you could do the stop loss. So let's go back to the basic one again. So this was, I think, 0.27. Yeah. Oh, yeah. That was most probably the correct one. Yeah. And what we'll do there is say, all right, what if we change the stop loss? To make it bigger would make it safer, so we go for 23 instead of 21, and let's see what happens. Oh, suddenly it's safer, but it is gives you less profit, and your risk return ratio drops tremendously. Let's go back to 21, just show you that. Now the risk return ratio jumps from 29 to 37. So there's a whole lot of very sensitive things that happen here. If we drop that down to 19 pips, see all of them are 90 now. Again, your income goes up tremendously. Your risk return ratio goes up tremendously. But now your risk of being stopped out is slightly higher, because you're now using a 19 pip stop instead of a 21 pip stop. So now I hope you're getting an idea of how to play around with this model and create some fantastic models. I've just created one that takes the income to $5,000 previously, and we've looked at some other ones that really do create some nice returns, and it's all by just playing around with these numbers that are in the yellow box. Remember, you can only fill in to the yellow box. If I try to change that, for instance, if I try to change that, it would come up with an error message saying, no, sorry, that's a protected field. Okay, so this calculator is fantastic for owners of the double in a day EA and also the RSI envelope EA, because this one will help you create fantastic strategies. Now, there's just another little model here that I need to tell you about, which is one that says, okay, let's get realistic about all of this. This is not going to happen that often. In fact, if you have 20 trades, it is likely that it will only happen once in the 20 trades. But it's not bad, because the other ones are all break even. Look, it's only that initial trade where you lose money. So let's say your initial trade has a 50% success rate. So 50% times 10, which is that number times 10, means you will make a $560 loss for 10. And then let's say the second top up is a 15% success rate. The second one is a 15%. The third one is a 15%. There are the numbers, and you actually make a small profit on those ones. When it finally hits the success target, it's only one, but it brings you in 2,100. So overall, in spite of a lot of losses, you can see 19 of these 20 accounts were unsuccessful, you will still make 160% return on your money. And quite honestly, this is how the successful traders work. They cut their losses down quickly, and they let their profits run. That's the whole philosophy behind double in a day trading. And I hope you've enjoyed this video, and I hope you now understand how topping up works and where the sensitivities in topping up lie, and how you can create some really fantastic strategies, and the fact that the model will tell you when the strategy doesn't work, and you know then to either increase your target distance in terms of pips or decrease your lot sizing or those kind of things. I've shown you the sensitive settings that you can start playing around. There are no rules. You have to do it by trial and error, but sometimes you find, like by error, I got a strategy that would take $1,000 to $5,000 if you use a 200 pip. Now you can download the model from a link in the description of the video, as well as in the first commentary of the video. Links to the double in a day EA and the RSI envelope EA can also be found in the description and the first commentary of the video. If you have any questions, please raise them in the commentary section of this video. So from me, Alex Deploy, thank you very much for watching, and cheerio. Just a quick disclaimer, this video has been made as an educational, entertaining and informative video for its viewers. It is not personal advice, and what works for some traders might not work for you. Please consult your financial advisor before trading. Trading is very risky and you can lose all your capital. It is not a get-rich scheme. Past results do not guarantee future results. There is no guarantee of easy success or good results in Forex trading. You cannot achieve the same results in the future by simply copying strategies and settings used by other traders in the past. And just a reminder, the Expert Forex live account broker is Exclusive Markets. And you can see some of the reasons why we use Exclusive Markets. They provide exceptional products, but also exceptional service. So when you use this link, you are linked to our personal account manager, and he will look after you. Furthermore, we use Dipgate as our VPS provider. We have 8 accounts running, and we are incredibly happy with the service and support provided by Dipgate. Now, it's important that you use this code, ExpertForex20, to get a 20% discount on any VPS services that you enroll for. Just a reminder to join our expert Forex community of over 30,000 Forex traders. It is free, so don't miss out on any new developments. A link is in the description of the video.